everybody for joining. We are going to have a pretty awesome meeting today. John and I have done a pre-call on this topic. So today we're going to discuss hard money basics with John Robbart. So John, not only a close personal friend of mine, but just an awesome, advocate for the group. Many of you know him already really well, but John is an expert at what he does, formidable force here in Tampa Bay, and also a top loan originator nationwide. So John is a senior vice president for Renovo Financial. He runs the Tampa Bay region with the team here locally. Last year alone, over $90 million in originations, and this year looking to eclipse that origination volume. Awesome human being, super sharp guy, and a great partner to his borrowers. So I highly encourage everybody, if you've not explored lending with John, to do so. But we'll let John introduce himself and take us through hard money basics.
Cool. Thank you for that. Let me get this share right. All right. Did I do that right? Okay, great. Cool. So yeah, we're gonna talk about hard money today and um, things you should know about lending and borrowing and how it works and what makes it a little bit different. So a little bit about me. Mark kind of gave a run through, but just to give you an overview, this is the agenda for today. We're gonna talk a little bit about myself, not too much. What's hard money? What's private money, hard money? What's the difference? What are some of the advantages? How do lenders make money? Short-term loans, long-term loans, and then we're going to take you through a case study of a real life burr, and I'm going to show you how I would analyze the numbers, and I'm going to leave you with an Excel sheet that I built that will hopefully serve as like a real tool that you'll use to underwrite in the future. So little bit about me. I've been in private lending since August of 2019. I started with a company called Triumph Capital, which is no longer in business. Out of San Diego, I moved back to Boston, where I'm from, right before COVID, literally like 2 weeks before COVID. Because Triumph went out of business, I started a company where I was brokering loans for a year and a half or so. Moved to Tampa in April of 2022, and then I got recruited to Renovo in July of 2022. Year to date, I did the math this morning. It's just over 300 million in loans I've done in my career, and this year we'll probably do just over 120. So growing quickly. So enough about me. What is hard money, private money? By the way, to set the stage, anytime I do a slide, like if there's questions, like please feel free to interrupt me and ask if you want to know how something works. That way we're not forgetting later. So this is a definition I came up with. So hard money or private money is just a type of financing that's designed for professional real estate investors who need money to buy distressed properties, and the intention is always to sell for a profit in the short term, or if their plan is to keep it long term, right? We talk about those as exit strategies. The way that private lenders, you'll hear me use this term, hard money lender, private lender. The industry is leaning towards this new term of private lender. So if you hear me say that, that's why I'm saying that. Is to focus 50% on the client and 50% on the deal. So I'm going to pick on Mark and Keeley quite a bit throughout this. So Mark and Keeley, obviously very experienced. That's why they're running this group and teaching all of you on how to invest and how to buy the right deals and that sort of thing. They have a very specific niche, right? So lenders like us would look at what's called a track record, which is a list of deals that they've completed, have the addresses, the date they bought them, how much they put into them, how much they bought them for, what they sold them for, how long they were in the deals, right? So we can tell a few things from those. And from that, we can kind of make some decisions off of them on the 50% client side. And we can also look at their financial picture, how's their credit, their net worth, how much money they have. And then we can also look at the deal and just kind of see, like, are these two things in line, and does it make sense? Do the two make sense to go together? And that's what I mean when I say here, are the two a good fit, and how profitable is the deal? Traditional financing, when I say traditional financing, I'm referring to the type of financing that you'd maybe get from Chase Bank or Rocket Mortgage, where you're going to live in the property. That is much better for people who plan to live in them, because those loans are designed for that purpose, and they're designed for properties that are already in livable condition. So think about like the right tool for the job. The right tool for somebody who's going to live in the house is not what we offer. the right tool for someone who does is that conventional mortgage. Similarly, the right tool for the job is not a conventional mortgage if the house is distressed and you plan to invest in it. So sometimes people want to try and jam what we call a square peg into a round hole for the purposes of getting lower cost of capital. And I'm going to dive into why that would be a waste of time here in these next couple slides. Um,
Real quick,
the
John, just a few thoughts come to mind. So you mentioned 50% of the underwriting is specific to the operator, right? So
mhm,
to the investor. So that's things like track record and credit. And then
yep,
the other half is probably more based on the deal itself, deal characteristics like the collateral, future value, et cetera. So a lot of investors, as they're first starting off, they're maybe thinking of hurdles to get them into a deal. I'm curious about on the personal side of the credit underwrite. What are minimum credit scores to get into a deal, and how heavily does the lender lean on the credit score as a part of the overall underwriting process?
that's a great question. So to answer the credit score question, our minimum is 680, and there are mitigants and there are sometimes some workarounds, but generally we do want to see better credit. And I'm going to talk about the different types of lenders that are both bank and non-bank for these types of deals. Um, the reason that you want to focus on having a good credit score is because candidly, it's the best indicator of whether you'll be paid back as a lender. So sometimes people say, "Oh, well, I thought it was hard money. I thought it was private money. Like, why do you need my credit?" Well, we have this one place that tells me three different bureaus that are telling me the likeliness that we'll be repaid. Why would you ignore that? So um, that
It's
was the first
680 is
question.
the Yep,
680
680
is
is
the
the
minimum.
minimum for Renovo. Is
Mhm.
there a situation where, let's say I have a 650, I can bring in a co-borrower, or are we still using the lowest credit score for
Yes,
that underwriting application?
fantastic question. It's the higher of the two, and the second customer needs to be at least 660 on the bridge side, and then on the rental side, the lowest person needs to be at 680. But we'll always use the higher of the two as long as it's either 660 for bridge or 680 for term. Term is the Renovo speak for DSCR loans. Yeah,
Thank you. Really helpful.
yeah, my pleasure. Anybody else have any questions before I jump onto this next slide? Okay. So there is, I'm giving two extremes here in this example here. I'm talking about traditional financing versus private lending. There is an in between, right? So there are banks in town, DFCU, I know is one of them, that will offer renovation loans for the purposes of investing. So I'm going to talk about the differences and why you might still want to opt for private money. So this is what I call a spectrum of lending. Spectrum of lending would be the bank. So I just picked on them, so I'm going to continue to pick on them. DFCU, they'd be the bank side, right? So on this end of the spectrum, where these guys are, they are going to have the most competitive rates, but they're also going to have the lengthiest underwrite and the longest timelines. If you're Mark and Keeley and you're buying another bungalow in Seminole Heights and you have plans to do a renovation, which is like right down the fairway for your business plan, your business model, um, part of the way you might be negotiating that deal is you might be saying, "Hey, uh, we can close in 2 weeks." Well, DFCU might not be on board with that. They might need 30 days, or they might quote 30 days and it might be 40 days. Whereas our business model is all ready to do this quickly. Like we already have systems in place to do everything quickly. Now, on the other end of the spectrum is even less underwriting. So at this point, remember, recall on the last slide, I said 50% borrower, 50% deal. These guys are 100% deal. And on the bank side, they are 100% borrower, right? They care solely about the financials. Do you have lots of reserves? Do you have good credit? Do you make lots of income? Right? On the asset based side, they're actually not even asking how much money you make, and they probably won't even run your credit. So they're probably a better fit for people who have, you know, subpar credit, right? 650 and below, right? Maybe even sub 600, right? Those types of clients would probably be better served at an asset based lender. And I've named a couple of them here on the sheet. RPM Realty. A lot of people have heard of Brian McGinnis. He's pretty popular here in town. And then Leonard Marks is another one who also lends money and is more collateral based instead of being there. So in any case, in the middle of this is me. When I say me, I'm really referring to other institutional private lenders that are lending money to real estate investors on a continuous basis. So our rates are more competitive than the asset-based lender, but they're not as competitive as DFCU. Our underwrite is easier than the bank. It's probably a little bit more difficult than what Ryan might require. Um, but it's kind of this nice happy medium, right? You're not paying 6 points, but you're also not having to wait a month and a half and clear all these endless underwriting stipulations. So it's kind of this like nice happy medium. So does anyone have any questions on this before I move on?
I
Um,
mean,
Before I get into this, I want to talk about some of the key players in a transaction and how to choose a reliable lender. And then I'm going to dive into our specific process. So there are a multitude of ways that you can get in touch with a lender like us. I mean, the easiest way would be to just call me, but there are some people who elect to work with a mortgage broker. Um, Mortgage brokers, I think, are more popular in the conventional world where they can shop to other conventional lenders, because that's kind of more how that business is done. In our space, you're essentially paying extra because they brought you to the table. Um, might be a little bit of an oversimplification. These people tend to serve more of a purpose in situations where the financing is a little bit more complex, like large scale multifamily, where these borrowers and brokers are a little bit more sophisticated. Um, so that's kind of a general gist. I'm going to talk a little bit about some of the things that make us reliable and why many clients in the area have chosen to work with us. But to give an overview of what our process is like in the event that any of you chose to work with us, essentially we have an initial meeting. The purpose of the meeting is for us to get to know each other and answer any high level questions that you might have. Some of these things might include how fast do you close, how do draws work, how do the loan terms work, those types of things. From there, we'll determine if there's a fit. If there is, then we'll move on to completing an application together, which typically is completed over the phone with me in probably 15 minutes. If there's a live deal, we'll run credit. Common question is it a hard pull or is it a soft pull? The hard pull is only the first time, and then that's good for 120 days. And if there are subsequent deals, you're buying multiple properties per year, a credit pull is good for 120 days. And then after that, we would do a soft inquiry, which does not impact your score at all. After we've got a credit pull, then we'll issue an LOI, assuming there is a deal. LOI stands for letter of intent. This is a formalization of our terms, and we'd spell everything out. I'd sign it, and then you, as the borrower, would sign it. From there, Erica, who's a member of my team, would send over a needs list. We'd get the appraisal ordered. She would introduce Michelle, our closer, and would get the title and the insurance agent involved. Once we have the appraisal back and all the items on the needs list, we submit it for approval. Once we have approval, get scheduled for closing. Generally, if everything is going the way it should, that happens in typically about 2 weeks or less. Any questions on this before I move on?
that's really helpful. So if we're thinking about that 2 week timeline, that's for kind of a, uh, straight and easy flip scenario. Let's say we're
Mhm.
doing a development project, which is like a little more intensive for the underwriting application. What should
Sure.
we expect for timelines if we're doing a ground up development project?
Yeah, great question. So on development deals, it's actually not that different. The big thing to be cognizant of with development is that you want to make sure that the project's permit ready. So
Yeah.
there was a lot of lenders that got themselves into trouble in the COVID boom of private lending, where they were originating loans to projects that, in areas that they weren't as familiar with, and they weren't clear on how long it took to get permits. So what ended up happening is there was a lot of loans that sat on that. So, we learned from that and realized that, hey, listen, we want to make sure that we're writing loans with appropriate term lengths. So, if we've got an experienced ground up borrower who has, um, a couple of, a few ground ups under their belt and they want to do a project, we would assume that if they have a permit and they're coming to us for a loan, that they'll be out of that loan in 12 months. That's the goal always. So to answer your question, Mark, it should be the same time. It's the same time period
Okay.
to get this process done, and that assumes that the permit's in hand. Sometimes I'll tell people, hey, you can start the process if you think you have the permit soon, and then sometimes they were wrong, so we end up waiting an extra week or two. But in reality, we were ready. So,
Yes, and
question for
permit
you.
ready before the application, right? And if we're permit ready, then it's more or less the same process.
Yeah, I mean,
to get
meeting an
started.
application happens frequently, whether people have deals or not, and we encourage people to do that. That way, they are ready if something does come up. But in the event that they don't have a permit or they're not totally ready, we welcome them to complete the meeting and the application with me, and then uh, when they're ready to start the process, that's fine to do that then.
Okay, I got a
A
question.
couple questions from the audience. David, go ahead. You
Yeah,
shoot first, and then I'll do the questions from the chat.
okay. In a situation where you're trying to get permits before the application goes in, I'm assuming in this scenario, the individual that's looking to borrow doesn't own the property yet. So are you suggesting that you identify, I guess, a target project where you want to do new construction and then start pulling the permits before you even close on the property and own it?
Great
Is that a
question,
common
David.
practice? Okay.
Yeah, great question. I probably should have clarified. The application is actually borrower specific, so it has nothing to do with the deal. It's an
Okay.
application where there's nothing about any potential project, and it's one application for everything. But to go back to your question about permits and like the timeline of things, typically what we see most frequently with customers, and again, this is typically reserved for customers who have experience with new construction, is
Hmm.
they'll buy the land in cash. They'll go through the
Okay.
entire process with their architect and with their builder to get everything ready, and then when they have a permit, then they're revisiting the conversation with the lender.
Okay. So are they borrowing, I guess in that scenario, are they just simply borrowing for the construction costs because they already own the land?
Um, the answer to that question is it depends, and it depends on the experience of the borrower and how much leverage they qualify for. In some cases, we can give them some money back. In some cases, we'll hold back some of that money and we'll use it as an interest reserve. So there's a variety of ways to structure it. In
Okay.
some cases, the land equity contribution is not sufficient, so they'll actually have to. It's what's called sponsor funding to
Mhm.
true up the equity requirement. So we'll
Okay.
close the loan, but they'll say, "Hey, I actually just did two of these last week. They said, hey, the first 50,000 you're actually out of pocket because
Okay.
of the equity requirement on that specific deal."
Okay.
Yeah. Any
So we have
questions in the
a
chat?
couple questions in the chat. Yes. So I think this goes back a little bit on this slide, but that's okay. What
Okay.
items are on the needs list? And then we have another, what documents will they want the borrower to submit?
Great questions. From memory, the items that are on the needs list: ID, two bank statements, most recent two bank statements for each account on your application that you list, your entity docs, so your articles of incorporation or organization, depending if it's an LLC or a corporation, either the bylaws or your operating agreement, EIN letter, purchase contract, scope of work, title contact, insurance contact. I think that's everything.
Next question was what documents will they want the borrower to submit with the application?
Typically, the application is just filling it out, and then ideally, we'd get a list of the properties completed. So some people have a track record, which I can also share our track record, so you can see what items we look for. But it's what I had mentioned earlier. It's a list of properties that you've completed in the last 2 years, where it's the address, purchase date and price, rehab budget, sale date and price, yeah,
And
that
then
sort of
I'm
thing.
sure we have to show some proof of funds or an operating account to show where the
Not in the
cash,
application. It's stated, so you'd say, hey, I have this much in my personal account with Chase, and I have
okay.
a business account at Truist, and I have this much in there, like that sort of thing.
All right,
Yeah,
very
and
good.
then when it comes time to actually do the deal, then you substantiate two statements for each account.
Excellent. Any other questions, guys, on the application process to get us from discovery meeting through closing on a deal? Hard money loan.
I have a
John, I'm
follow-up.
gonna go
Sorry.
ahead, Keely.
I was going to say I have a follow-up question to David's question about new
Sure.
construction, and maybe we're jumping ahead though.
No, go ahead.
Is when you talk about the equity requirement, is there like a blanket standard for that? Is it a percentage of the total build cost? Is it like is there a standard that we're looking at for that, or does it vary deal to deal?
Yeah. So the equity requirement specific. Your question is specific to ground up. I'm hearing. Yeah.
Correct. Yeah.
Yeah. So the equity requirement varies based on the customer's experience and what they qualify for. So we have a tier system for how many have you completed in the 2-year period? That determines what loan to cost you qualify for. There's also other nuance, like is it a purchase, is it a refinance, are there permits in hand? So, let's say it's anywhere from 75 to 90% of the total cost is what Renovo as the lender will finance. So if I
Okay.
tell you, hey, it's 80%, that means that there's a 20% equity contribution. And
Makes
I'm going
sense.
to dive deeper into the leverage metrics in a few slides. But to answer your question, let's say it's 20%. If the total cost of the project is $1 million and you bought the land for 300, well, you're already 30% equity contribution in. Does
Right.
that make sense?
Yep.
Okay. Cool.
Awesome. Thank you.
Yeah, my pleasure.
Quick question for you, John.
Shoot, David,
I'm
what you got?
assuming you only lend out to entities, correct?
Yes. Yeah, great question. Only to LLCs or corporations. There's some lenders actually out there, some private lenders. I am doing this in the spirit of transparency that will make loans to people in their individual names. And candidly, I don't see a benefit to the customer for doing that. I mean, it's cheap to set up an entity. I think it's like $160 in Florida and probably even less in other states. So there's not really any win aside from just one less thing you have to do. But I mean, it's one of those things where it's like this is a business and you should treat it as such. So I would recommend creating one.
I would think the separation as well would be more advantageous, right? By having the entity there in place and borrowing in that, right? Yeah.
Yeah. Yeah. Exactly.
For those, if you didn't capture it, so your expectation as you go into a deal, when you find a subject property, is that you have to give yourself at least 2 weeks to get through your loan process. That's really important. Speed is the name of the game. So when we're thinking about securing contracts, usually the shorter terms are what helps you secure the deal. But you still want to give yourself some breathing room, at least 2 weeks from the time that you identify a property. And by the time you get a property under contract, you should be speaking with your hard money lender, maybe even prior to that time, so that you have all your ducks in a row to get through that transaction smoothly and easily.
Yeah. And separate from that too, speaking about having that timeline in place, you're going to want to make sure that your entity's set up. As much as I love living in Florida and how easy everything is here, setting up your entity is easy, but the state sometimes gets backed up and it isn't overnight to create an entity. It is in some states. Florida, unfortunately, is not one of them. And the time that it takes varies. There's actually a thing on the Sunbiz website that'll show you what their processing dates are. So you can look and it'll be like, okay, today's the 2nd. We're currently processing online submissions from the 27th. So you can get an idea of how long it takes. But again, I would advise, like, if you're serious about investing in real estate, like setting up the entity, like you do not need a deal for that. You can
Hey,
create
so I
a
have
general one.
I have another question for you, like
Sure.
regarding, I guess, like the lending to LLCs, right?
Mhm.
So, like, let's say that our track record, right, is under one specific LLC,
Mhm.
but we want to purchase properties under other LLCs, like let's say we're going to plan to burr something and we want to have that in its own LLC. We want to separate that kind of from the other ones, right?
Sure.
When we're making application, are you guys kind of taking into account like the assets that like the main LLC owns,
Mhm.
and but you're okay with still lending to this like brand new LLC because it's still based off of like those individuals and you can see from their other LLC that they've got the track record, or are they kind of treating every LLC separately?
Yeah, it all ties back to the individual borrower. So I actually have a customer who does townhome developments in Tampa Heights, and because of the size of his developments, and he raises money from individual investors, so every project gets its own LLC, which makes sense when you're doing deals of that size. I think if you're doing, an average of 3 to 4 flips at a time, I mean, consult with an attorney for sure if you want their legal opinion. But from a simplicity standpoint, what I'm seeing most frequently with customers that I work with is they have an LLC that they do rehabs in, and some of them keep everything in one. They keep their rentals in another. That's fine. But to your question of like, how do we count what? Everything gets tied back. So if you choose to have 10 LLCs for 10 deals, it doesn't matter. Like we can just see your name on there and it's good. Or you can elect to have it all together. It's totally up to you. It makes no difference.
Gotcha. Okay.
Yeah. Sometimes people think they're like, oh, well, I did all my deals in that LLC, so now I can't leave it. Like that's not true.
Right.
Our
That makes
group.
sense.
So we recently had a real estate attorney on with us for an SME call. And I think the guidance there was you don't want to have more than $600,000 of equity exposed in one LLC. So
Got
once
it.
you reach, between capital committed and equity on your projects, 600 grand, then it's time to think about a new LLC for asset protection.
Got it. That's probably pretty decent rule of thumb. You also have to think you have insurance in there as well. So I don't know if they covered that. All right, I'm going to jump into this next slide here. How lenders make money. So there's a variety of ways. I mean, the first and most obvious one is interest. Um, Second is an origination fee. So interest is charged on an annualized basis. Um, so if it's only a few days, they only make a few days worth of interest. So there is an origination fee, which is one thing that differentiates private lending from conventional lending. When I say conventional lending, I'm talking about the loan that you got for the mortgage on your house. And that fee varies from 1 to 3 points. Most often we are doing somewhere between 1 and 2 points, but I did mention the lending spectrum. I've heard of Ryan McGinnis charging anywhere from 4 to 6 points. But again, he's kind of like a lender of last resort for many. There are closing costs, which is different from an origination fee. So an origination fee, the way to think about it is like this is prepaid interest. Whereas a closing cost is like cost of doing business, like a processing fee is like the cost to keep the lights on and the cost to pay the staff. Um, there are a myriad of fees that some lenders charge: credit report fee, app fee, processing, doc prep. I mean, I've heard of it all. On our end, we have one processing fee. It's typically $1,500. It does vary slightly depending on what it is. Like if you're doing a large loan or if you have a complex entity structure. In other words, it's layered, right? Mark, for example, has the Toro companies, and if that was owned by Toro Holdings, which is owned by Toro this and Toro that, and then up at the top is Mark Toro, we would charge a fee to review all of that. So I always encourage people just keep it really simple. Toro companies, it's owned by Mark and Keely Toro, done deal. Like that's the recommendation that will make your life so much easier. And then loan servicing is another way. So, Renovo, one of the things that differentiates us a little bit is that we're not just a lending company, we're also a loan servicing company. So we service all of the loans that we write, and we've actually grown that business to a point where we're not only servicing our own loans, we're also servicing some of our competitors' loans and some other people that are not even in our space. So pretty cool to see how the company's grown. Any questions on this before I move on? Awesome. So a few things to focus on that I think that we do really well is speed and certainty of closing. I talked to this in a few of the earlier slides, but big thing is how quickly can your lender get it done? If you're able to negotiate a deal, you close it in a week and a half or 2 weeks. Like, can your lender deliver on that? That's important. Knowing the area, I think, is pretty valuable. I mean, I spoke with a woman on Saturday, and she was telling me about a deal she had in the area, and she told me the numbers, and I was like, that doesn't sound right. And then I looked it up, and I was right. And having someone who's looking out for your best interest and isn't just trying to make a buck originating a loan, I think is pretty important. Which ties into my next point, which is a focus on relationships. I hear all the time from the people that I work with. They're like, "Oh, so and so's calling me, offering me this, offering me that," and sometimes I tell them, "Hey, you know what? You should try that." And the reason you should try that is because everything has a catch. There's no such thing as a free lunch. If a lender's offering you really low rates or whatever the case is, uh, it very well may be everything that you hoped for, but it could be too good to be true, and that's something to be cognizant of, right? Like you might end up paying for it in other ways. An example of that could be, hey, if the draws are really slow, that might end up costing you money because you're having to rob Peter to pay Paul to pay for your construction draws. So that's something to keep in mind. And then lastly, the servicing, right? Like, what's the process like when you have to get in touch with people on their team, whether it's construction draws, whether it's the people on the administrative team where you're like, hey, did you receive all the documents, or I sent you the updated bank statement, or like what's the response time like? Is it within reason? Like, is it within a day, or is it to take like 5 days for them to get back to you? So those are things to think about when you're working with someone for this sort of thing. Another
I just
one, and
want to
it's
take a
not on
second.
this slide.
Okay, you can
I
finish
was
up.
to say one thing to ask, and I forgot about this because I do this all the time, so I don't think about it. Is a common thing is, and I'm going to dive into this more in the next slide. Is how the lender charges interest. So there was a trend for a while where lenders were offering lower advertised rates, and they were real. They were giving real rates, but what they were doing was they were charging what's called Dutch interest. So Dutch interest means that they're charging interest. If you think about the way the loan is segmented, right? You have the loan, the section that's for the purchase price. We call that the initial advance. I'm going to talk about some of these terms in the next slide. And then they also have the construction holdback. So those two components make up your entire loan. Now, what some lenders will do is they'll say, hey, we're going to give you a lower coupon, a lower rate, but we're charging interest on the whole thing the whole time. Whereas what's more common, and this is the way we do it, is we charge interest on the money that you've used. So we'll charge interest on the money toward the purchase price. And then as you draw down from that budget, you pay interest on the amount that you've used. So it's a pretty substantial savings if you're doing larger projects. Like, I mean, like for those of you who are at the branch renovation, like that is not a low rehab budget. So that is substantial. Now, if your rehabs are small and they're like 20K, then it might be worth it to pay Dutch interest. But anyways, I thought I'd share that. Mark, did you have something?
All really helpful. So I just wanted to take a second to just kind of express the importance of viewing your lender as a partner. So if you think about all of these icons here on the screen, so speed and certainty of closing, that's huge, right? So we talk about track record for the borrower, but I think track record for the lender, making sure that you're working with a lender that can close deals as they promise is everything. You don't want to lose your escrow because your lender is not really keen on the process. They don't know your market. If they go over by one day, you can be in a position to lose your escrow because there are always backup offers on your offers on off-market property, distressed property. So being sure that you can close is more important than getting low fees and low interest rates, right? So I can't express how important it is for me to know that my lender will close as they say they will close. That is everything in this business. Local knowledge, super important too. So your lender should not only be lending you money, but also should be giving you advice in different aspects of your project, giving you referrals for contractors, or maybe even pointing you towards other market players that have advice on some aspect of your project that you're not an expert on. And I know John for certain does that. And then this idea of superior servicing. So the draw process. So this is liquidity and cash flow is a very important part of the business, especially as you're scaling to multiple projects at a time. So some lenders, their draw process is so cumbersome, it might take 2 weeks to get your cash back on a draw request. And they might also have their own nuances for how they calculate your draw request. So you request 50,000, they go out to the property, they send an inexperienced, asset manager there, and you request 50,000, they actually give you back 30,000. So now you have 20,000 less than what you were anticipating to run your business, which is buy the next deal or pay vendors for, subsequent parts of the project. So all of these things, making sure that your lender is really buttoned up in all these areas. It's absolutely everything. So treat your lender as a partner. Not that you don't want to be, focused on making sure that you get great terms, but I think more important, focus on the relationship and making sure that you have a trustworthy partner that wants to see you win in all of these areas. It's everything in the business. People don't buy houses, lenders buy houses, right? And if you're in and around the industry long enough, you realize that and you start to look at your lender as a partner.
I want to piggyback on that just and expand on a couple of things just a little bit more, which is like the local knowledge aspect of it, right? If you use one of these hard money lenders that's just like a national lender, they're based out of Texas, they don't really know your market, they don't do business here, right? And you are purchasing a home in an up and coming neighborhood or somewhere that's nuanced, right? The lender is able to recognize a bad appraisal or advocate why this is not an appropriate comp, or make sure that they're choosing an appraiser that also understands those market nuances. And where that's important is, let's say that you have a killer deal in an awesome neighborhood that you want to pick up, and you put $10,000 in escrow, you know what you're going to do with this property, it's going to be amazing, and you have a crappy appraisal, and now you can't get the financing, and now you can't close on the property, and your escrow is hard, and you lose that money. Well, guess what? When your lender is a partner to you, and when your lender is local to the market, right? They also know and trust that, yeah, that piece of property is an amazing purchase, right? So again, like just kind of getting in front of issues that would prevent you from being able to purchase good deals. It really does start with that relationship with the lender and being in relationship with somebody that also sees you as a partner. They care about your business. They want to help you succeed. It's a long-term relationship and vision. And one thing that I would say, because I see a lot of investors, like they'll shop lenders and they'll kind of jump around, right? And because they're doing that, they're like nickel and diming, right? And they're trying to pit one lender against another lender. Oh, this guy said he can get me this. And, it's all about the money. That's a really easy way just to like kind of turn somebody off from working with you and start a relationship off that could be extremely beneficial to you on a really negative, sour note, right? So, there's a lot of value in like working together because that lender might come across a deal that another investor doesn't want to do that he know like if that's your lender, like John knows that we work in the Heights. So if he has another one of his investors that's like, hey, I got this property, but I don't have the funds to do it. And John's like, oh, I have these other people, like they would be great for this, right? And so oftentimes, like a lender partner can bring you deals, they can give you advice. It's a relationship where, let's say you have a property that's kind of iffy, you can pick up the phone and call and say, hey, can you look at this real quick? Like, let me know, is this something that you guys would lend on? Like, you need to have a lender partner. So, that's number one. And then the other thing is like the servicing side of it. Especially like newer investors, it's super important when you don't understand the draw process. You're already overwhelmed with dealing with contractors. You're already overwhelmed with the renovation. You don't also want to be overwhelmed by your financing. Like that should not be a headache for you, right? So working with a good lender who, and I'll say this, I see lenders on social media that look like they're great lenders on social media and they're not so great in terms of the customer service, and you hear horror stories or the draws are terrible or whatever it is. So get a referral, work with people that other people have had a good experience with and can say like, nope, when I work with Renovo, like we get our money right away. I've never had an issue. John's always available for calls, like whatever that looks like. Again, you don't want your hard money loan to be an added stressor in a business that's already extremely stressful. So that's all I got.
Thanks, Keely. Appreciate it. All right, I'm going to dive into some of the lending metrics and things that we consider when we're making a loan. And this might get a little bit complex, so please feel free to interrupt me and if you have questions. So for bridge loans, there's really three main things that we look at. So there's initial loan to cost, total loan to cost, and loan to ARV. So I gave an example here, and I gave some of the answer, but I didn't give all of the answer, and some of it's going to require calculator. So the most common way that the loan amount gets determined is based off of this first number, this initial loan to cost, right? So, I'm using 85. For some people, it's 80. For some people, it's 90. But just to keep this easy, it's 85. So we got an average deal. I picked average purchase price in Tampa is 400,000. I'm just trying to keep it as easy as I can here. So 400K purchase. Spend 85%. We lend you 85% of the purchase price. That's 390, or excuse me, 340. And then we would give you a 50,000 construction loan attached to that, right? It's all one loan, but it would be held back at closing. And then the ARV is 585. So the way that the loan gets broken up, right? We're lending 390, we hold back 50, 340 is our initial advance. So our initial loan to cost, if I'm looking at this top thing, so I don't know which way the screen's pointing, is 85% of the purchase price. That's our initial LTC. And then we have our total LTC. So the way to figure that out is 390 divided by 450, right? Because our total loan to cost is purchase and rehab together, which is 86.6%. Okay. Typically, for somebody who's qualified for 85, the max would be 90 total loan to cost. And then you have loan to value or loan to ARV. So now our total loan is 390 and our ARV is 585. That's 66% loan to value. So those are the three metrics that we're looking at. Somebody who qualifies for 85, it would be 85, 90, 70, meaning we wouldn't exceed 90% of total cost. We wouldn't exceed 70 loan to value or loan to ARV. Those are interchangeable. So those are a few things that we look at. So in the previous slide, I was talking about Dutch interest, non-Dutch interest. If you're a customer who's getting non-Dutch interest, that means you are paying only on the 340, and then as you draw from that 50,000, the payment goes up. If you're paying Dutch, you're paying interest on 390. The payments don't change at all. Any questions on this? I know it's kind of a lot of math.
Yeah, I want to make sure we get it for the group. So if we think about we're buying this house for 400,000,
Yep.
and you're saying the initial loan to cost is a percentage that the lender has determined that they will lend on that initial purchase price.
Yes,
So
and
let's
that
say,
is
for
based
instance,
on the investor. And remember, we talked about 50% borrower, 50% deal,
yep,
right? Like
yep.
that is determined here.
Okay, so let's say I'm a early stage investor. I'm
Here you've got
probably
three deals
eight.
done, for example. You got
Yep,
3 deals
three deals
completed in
done.
2 years. Yeah,
Yep. So maybe an 85% loan to cost is my qualifier. So
sure.
I'm buying for 400,000, and that initial loan cost calculation is going to be 85% of 400,000, correct?
hmm
Okay, so that leaves me at 340,000. And
hmm
then the next calculation is the 340,000 plus the additional 50,000 for rehab that the
Yep,
lender is giving me, right?
yep,
So then I'm adding 50,000. So that gives me 390,000. And that 390,000, we're then dividing it by the future value of the home
hmm
to see what the risk exposure is to the lender, right? How
yep,
much risk they're exposing themselves to. So 390,000 is what they're actually lending me in dollars. So 390,000 divided by 585,000.
yep,
And you said that gives you that 66%, which is under 70% of the future after repaired value, right?
yep,
So for the group, if you're thinking about what you need to bring to the table in this scenario, you're bringing 15% of the $400,000 purchase price. And because you're buying a good deal where the ARV is fairly high, that's all you have to bring to the table, right? If the future after repaired value was lower than 585, let's say it was 550 or 525, that might trigger you to have to bring more money to the table to make sure that the lender is uh, safe at their risk exposure level, right?
right.
So they want to be under 70% of the future after repaired value. I want to make sure I explain that right, John. I know I just kind of paraphrased what you said, but
Yeah, so
for us through our lens, we're thinking, hey, how much money do I have to bring to the table, right? I think that's the biggest thing for us.
totally, totally. And we can also flesh that out, right? So let's say that you were doing an ARV of 520. Well, more than likely, there's not enough margin there. So we would back into what our initial advance is. So if I start at 520 and I lend you max 70 of ARV, that gives me a total loan of 364, right? I just did 520 times 0.7. It's 364. Now, we as the lender, we want to make sure you are successful throughout the project. So we always want to lend the full rehab budget. Now, the full rehab budget is 50,000. So minus 50 leaves us with 314. So your initial advance now, it's not 340, it's 314. So what does that mean? How much money am I bringing down? Well, it's the difference between
26.
400 and 314,
Yep.
right? So now you're bringing 22.5% down.
Right. So for the group, what that looks like is 15% of the 400,000, but because my after repaired value, I don't have enough margin, right? I'm not creating enough value. It's 15% of the initial 400,000, and then I have to bring the difference, which is $26,000. I have to bring that difference to bring my total loan amount to under or at 70% of the after repaired value. So in the deal example here, it's a nice margin, right? 585. We're under that threshold of 70%. But if for some reason that future after repaired value, and that could be, hey, the appraisal didn't come in as expected. We think the value's there, but the appraiser says it's not. That happens, guys. So be prepared for it. But the idea is
Yeah.
that if that number comes in lower, you may have to bring more money to the table just to keep the lender comfortable at their 70% risk exposure always. So, when you're calculating your deals, yeah, 15% of the purchase price if you're early stage, maybe a little bit less if you're more experienced, but let's count on 15% for those first few deals. And then if you're underwriting, if the actual appraisal comes in shorter than expected, or maybe it's just lower right from the onset, expect that you're going to have to make sure that the lender is only exposed to a total loan amount that is 70% of the after repair value.
And similarly, right, like this goes back to having a lender partner, right? Not just somebody who's making a loan for you. A lender partner would look at this and go, man, I'm not seeing 585. I don't think that's a real number, right? Uh,
That's in the
you know,
beginning, meaning right when you bring them the deal, hey, I just want to be honest with you. When I look at the comps, it doesn't
right.
look as optimistic as you think it does, right?
Yeah, and sometimes I have those conversations with people and I go, man, I'm not seeing 585. And they go, oh, well, I forgot to tell you, I'm adding 600 square feet. So now I got to look at a totally different set of comps, right? So that's happened before.
John, quick question on the lending side. Are you more risk adverse, right? So if the market says 585, but do you try and take a haircut off that a little bit? Or like, how do you really evaluate, the ARV and like, is it true to market or like, are you
I
trying
love
to?
that question. I love that question. In our internal approval submissions, this is not something that you would see, but in our internal submissions, we as a lender will underwrite to a 10% market haircut. But for the purposes of your loan, we're not. Right. And we do a very high level profitability analysis, and it's just ARV minus 10%, minus purchase price, minus rehab costs, minus interest expense and closing fees equals profit. And then what is that as a percentage of the sale price? Kind of similar to like the way Mark was doing it on his sheet, those sheets that he gives out. It's kind of similar to that. But for the purposes of your loan, it's like, no, if the appraiser said the ARV is 585, like that's the number.
When you think about the haircut that you guys take, that's for your own measurement of
That's
risk
just a
across your
standard thing that
business,
we do.
right?
Yeah. If
Yeah,
the market shifts 10%, are they going to be okay?
right.
Yeah.
So John, do you actually send out an appraiser to the property and get an actual estimated after repair value? Is
That's a
that what you're
great question.
suggesting?
Yeah, it's a great question. Yeah, we work with 3 local appraisers here in the Tampa area. I've got appraisers in other markets for stuff I do in Jacksonville and Miami, but yeah, we essentially have 3 that we go direct to them. So this is another thing that I probably should have included in here. I just wasn't thinking of it because it's just so part of my day-to-day life. But some lending companies will use what's called an appraisal management company. And Michael, who is a appraiser, can tell you how fun it is to work with those people. Essentially, uh,
Middleman.
they've institutionalized the middleman business, and what they do is they essentially will act as a barrier between the lender who's placing the order and the client and the appraiser. And then what they'll do is they'll give the order to an appraiser. The appraiser goes out, does the work, then comes back, and then the appraisal management company will sometimes beat up the value and they'll beat up the comps and they'll make the appraiser go back and do it. So now we're adding time onto this thing. And then once the appraisal management company deems that it's good enough, then what they'll do is they'll come back and then they'll now give it to the lender. And the lender will now do the exact same thing. So now this appraiser is, who by the way, at this point is just thrilled to be doing this order, is going, oh man, like what else? Like how many more revisions do you need? Right. Whereas with us, these 3 people, and we just send them the order. And most of the time, like they know what we're looking for, they know what we're comfortable with, they know. And so, yeah, I get orders back in 2 days. Like it's not a lengthy thing. A lot of times we hear appraisal and they're thinking of what it was like when they went to purchase the home that they live in. And they're like, man, that took like 2 weeks. Like, why the hell do I want to do that? Like, why is this lender requiring an appraisal? This is private money. It's supposed to be quick. So it is quick. And for certain customers, right, typically more experienced customers will even do just a drive-by where the appraiser literally just drives by, takes a photo, and he does this whole analysis and he makes assumptions about the inside. Like,
The other thing,
Oh, sorry.
real quick, I was just going to add the other reason why I would ask hard money lenders whether they have direct appraisers or whether they use an appraisal management company, an AMC, is because you get what you pay for, right? So the appraisal management company gets hired by a lender, and the lender, may tell them, hey, we need an appraisal done. And they say, okay, well, that's going to be $1,000. But then when they outsource that, they're obviously keeping a huge chunk of that for themselves. And so then they're kind of like blasting this out to whoever's in the network. And they're saying like, and my understanding of this, and I may be incorrect, but my understanding of this is they'll go in super low at first. So they'll say, hey, we have an appraisal at 127 Main Street that we'd like to get done in a week and a half, and we'll pay you $200. And then if nobody takes it a day or two later, they say, okay, we'll pay 350. And then if nobody takes it, right? And so they're trying to keep as much of that difference as possible. And so
That's the
now
business.
you're waiting a week for it to even be assigned to an appraiser. And then the appraiser's only making a few $100s off of the appraisal. So he's going to try to do it as quickly as possible. He's probably not going to really dive in, especially if it's like a difficult property to comp, right? Like you're probably not going to get the best analysis on the deal. And that can, again, make it so that you don't end up buying this property, because if it appraises low and he just used crappy comps, the bank is going to say, well, this is the appraisal. Sorry, we can't lend you on this property. So I think that's another good question to ask when you're interviewing potential lenders.
It's an amazing question to ask. Like I would
Yeah, like are they
100%
using their
ask that.
own? And the other thing too that I've found with appraisal with appraisers that come from, and I've attended a lot of appraisals. So they're not the best quality. A lot of times they're also not from the area. So you have like Tampa, right? We've got a ton of work here. But as you go out into these more rural areas like Dover and Riverview and Spring Hill, like we'll have appraisers that drive here an hour and a half to do appraisals, and they come to Tampa where they can do like 5 appraisals in one day, drive around, take all the photos, but like they're not even from here. So they don't understand like the nuances of the market. So
agree.
So John, all of your appraisers, they're local to the Tampa Bay. Do you guys use the same process when you're going into hard money as when you're going into a long-term exit strategy like a DSCR or something like
Same
that?
people.
Or do you have to, okay, same people, same process? Okay,
Same people.
cool.
Yeah. And I try to, I actually, this is like more out of kindness for them, but I try to give them orders based on where they live. So like one woman I use, she lives in Apollo Beach. So like I tend to give her like the Palmetto, Bradenton, those types of deals. My other guy's in Temple Terrace. I have another guy in Lutz. So like that's how I do it. But sometimes it just comes down to availability and like whoever answers the phone first and whoever looks at the deal with me first, that's who gets the order.
And I assume that's one of the reasons you guys are able to close as fast as you are is because you've got a pretty quick an appraisal team, right?
Yeah, yeah, and we have the ability to do BPOs, which I can talk about what that is. It's stands for broker price opinion, and Keely, I think you actually have some experience with those, don't you? It's essentially the same thing as an appraisal. It's just not completed by an appraiser. I mean, a lot of the the comparison table and the adjustments to the comps, like a lot of that, there's a lot of similarity, but it's not completed by a licensed appraiser. Therefore, it's called a BPO, broker price opinion. We have the ability to do those, but I mean, we have relationships with these people and they've done right by us and we want to do right by them. And the savings is like $150. Like it's not really worth it for me to. I also have a harder time getting a hold of the BPO people. Like my appraisers, I can call them and they'll be like, "Oh yeah, it'll be ready in an hour," and it's ready in 30 minutes.
So chances are, let's say we go through a loan process, and we get into a hard money loan. You send out appraiser A, they come check out the property. They're like, this is what I think the current value is, but considering, these renovations as they're outlined, we think it'll be, 585, right? And then we come back, 6 months later, and we start talking about the long-term exit strategy at DSCR for the Burr method. You could send the same appraiser back out and they'd be like, yeah, it checks out. I'm gonna, we're gonna ship it at 585. Is that pretty much kind of how the process would work?
Pretty much.
Are you likely to send the same appraiser out then because they took it in the first place, or okay?
A lot of times, yeah.
And I think there's a huge advantage to that because again, like just the mentality of people and especially the egos of people, it's highly unlikely as long as you did the work the right way and you did what you said you were going to do on that initial scope. Now, if you said you were going to add a pool and you never added the pool, obviously the appraiser's going to say it's worth 520, you never added the pool.
Yeah.
But like if you, assuming you did everything that you had submitted for that initial that initial game plan and that the comps really haven't changed dramatically, the appraiser's not going to be like, well, you know what, Mr. Lender, 6 months ago, I almost screwed you over. Good thing this guy finished it because this house wasn't worth 585. Like, of course he's going to say, yeah, it's worth 585 because otherwise that makes him look bad to the lender, right?
Well, similarly, if like the market shifted and there's comps that sold for subpar numbers, like that's a real thing. Like that's not your fault or his fault. The market shifted, like that happens.
Yeah, for sure. Especially like since the hurricane and flood zone areas that just absolutely got wrecked by Helene, I can
Could.
imagine it's a
Right, but you
different.
want to make sure that the comps are like for like, right? So the appraisal order is going to be what we call as is and subject to. So subject
Sure.
to comps, he's not going to pull flooded houses. That'd be
Right.
silly. Yeah. So
Great. Awesome.
cool. I'm going to jump into risks and considerations. I know we're going a little bit over time here. Let me know if anyone
We
has
don't
any
have a hard
questions.
stop if you don't, John. I know you can get back to your day.
No,
But take
I'm
your time.
good. So things to consider, rates and fees can add up. Shorter loan terms. So, first and foremost, I'm gonna dive into the rates and fees when I get into my presentation on like how to analyze a deal and annual uh, calculating your holding costs. Um, Something that I think a lot of people don't factor into their mental math as they're doing this. Shorter loan terms, sometimes 12 months isn't enough time. And if you're not experienced at investing and you don't know how to manage a project, you can go over, and that can be costly because extensions are not free. And you want to think about your exit strategy there. How many doors out do you have? You have a door out to sell, and then another door out is to refinance, right? Those are kind of the two main ones. In some cases, maybe you'll decide you want to keep it and you'll live in it. So maybe that's a third door out that maybe you didn't consider. But I would put that in the refinance camp because either way, if you're living in it, we're not going to be the lender anymore. And then what to do if it doesn't go as planned. So like, when you're going into a deal, like, hey, is this like something that, if this doesn't go my initial planned way, like what are my options? So those are things to think about as you go through this. And I can dive deeper with anybody if they have something. So we'll quickly talk about some of our loan programs, some of the different things that we offer. So this is the real thing, but to keep it really short and sweet, it's buy and rehab, buy and hold, new construction. Those are the three things that we do. And then, buy and rehab and buy and hold is really 1 to 30 units. And then new construction, we offer 1 to 4 units, or we can do portfolios. We also have the ability to go over 30 units and um, larger construction developments, but that falls into a separate program. And I don't, it's kind of like for an upper, very, very seasoned investor who has lots of experience with construction development. So this is an overview of what we offer. When I say buy, I also mean refi, buy, rehab. I kind of use buy or refi, kind of use those interchangeably. Any questions on this before I move on? So kind of talked about this a little bit, but just to reiterate, like what's a short-term loan, what's a long-term loan? Short-term is 12, it's really 12 to 24 months. When you loop construction in there, that does come up. And then long-term loans would be 30 years, and that's typically a fixed rate. So we talked about appraisals, to kind of talk about this. I don't really think this is a big concern with us, but it is important, right? So being there, telling them what they've done, telling the appraiser what you've done. You're welcome to provide an appraiser with comps. Like I don't think there's any rule against that. You can show, hey, this is what it looked like before, and obviously you can see what it looks like now. Pre-walking the property and making sure that there isn't trash or paint buckets or drop cloths or painter's tape or tools out. You want the house to look complete because the lender, we are only going to have one impression, and that's what we see in the appraisal. And then lastly, if it is a DSCR, right, like you want to think about your tenants and treating them with grace and respect and being appreciative that they're allowing you in, because ultimately you're getting something out of this, which is that you're going to get to keep the property and refinance it and ideally pull some of your cash out.
Touch on this, like the importance of it. So there's no any aspect of this business you should really, take ownership of it, right? So yes, we are ordering the appraisal, but you still want to be a part of that process to guide the outcome. So to give you an example, we had a project that I think we were 150, we secured a contract $150,000 above any other comp. So naturally, right off the bat, not that that's a red flag, but hey, what's going on here, right? So on that appraisal, I actually submitted our actuals to the appraiser to show, hey, this is a $200,000 rehab, right? Because as they're walking through the property, they may not be familiar with construction costs, right? So I sent the actuals, which are inarguable. Here's the money. Here's who it went to, down to the penny. I sent them my whole spreadsheet that I use to run the business, along with our comps, but just so they can see the actual money spent on the project, and that helped us secure that appraisal amount for our buyer. So you really do want to be involved, be buttoned up, and to John's point, you can be really active in this process to make sure that you get the best outcome possible.
Well said. Thank you. Talk about some of the ways that you can get better pricing on the rental loans. So we didn't really touch on this, but the pricing for the bridge loans is largely tied to the number of deals you've completed, right? So somebody who's brand new, hasn't completed a deal, is going to pay a higher rate versus somebody like Mark and Keely who have done lots of deals, right? And more specifically, we're looking at how many deals are completed in a 2-year period. So it tells us how active you are. If you're more active, you have better chance of succeeding, right? These are ways to mitigate risk, because by making a customer put more money down or by charging a premium for the money, right? Now on the DSCR side, it's really not experience focused. It's kind of credit is the big one. And then besides that, it's loan to value. So these are some different things that can affect it. The higher the loan to value, the higher the rate. And then we offer 3 prepayment penalty options. So talk about what a prepayment penalty is. Wow, I'll say that 3 times fast. It's a penalty for paying the loan off early, whether you're selling it or refinancing it. And the numbers here, 5, 4, 3, 2, 1, refers to a percentage of the unpaid principal balance that you would pay when you refinance. So if you pay the loan off the first day, well, you close the loan and the next day you say, hey, I'm paying it off. In this first scenario here, in this first scenario here, 5, 4, 3, 2, 1, you're paying 5% of your loan balance day one as a penalty. And then this goes down. So in the next calendar year, it's 4%. And the next calendar year is 3, and then 2, and then 1. Or you can do 3, 2, 1, or you can do 3, which is a 1 year. And those, obviously, the 1 year is going to be the most expensive rate because we're offering the greatest flexibility. So we do offer a few different loan types, 5, 7, 10-year adjustable rates. Without getting too nerdy here, whenever there's an inverted yield curve, which basically means whenever shorter term treasuries are offering a greater premium than long-term treasuries, there's not a lot of benefit to having an adjustable rate. The adjustable rates are good when the 2-year treasury is less expensive than a 5-year treasury. So as long as we're in an inverted yield curve, ARMs are really not even something to think about or consider. So, and then also cash out, there's a premium for that. So, each of these things is like 20 or 30 basis points, right? Like a loan to value, you're talking about maybe 10, 15, depending on which loan to value. Prepayment penalty is, from 5-year to 3-year, we're talking 25 to 30 basis points. From 5-year to 1 year, you're talking like 70 or 80 basis points. The ARM right now, if you were to go from a 30-year fix to a 10-year ARM or a 5-year ARM, you're talking about maybe 5 basis points. Like at best, it's not advantageous. And then debt service coverage ratio, like we offer a pricing benefit if the debt service coverage ratio is 1.2 or better, and we'll make loans as low as 1. So 1 debt service coverage ratio, and I'm going to cover that in the next slide here, and how that's calculated, just means that you're breaking even.
And so there's real quick, John, for the group. So, a lot of us, of course, we're flipping houses in this group. We have ground up development going on, but there's definitely a few folks that want to build rental portfolios, right? And I highly encourage that. I wish Keely and I kept more properties over time. But let's say our goal is to do a lot of BRRRR properties, right? Buy, renovate, refinance, repeat. If we're doing an example where we have a 75% loan to value, we have a debt service coverage ratio of, let's say, 110%. What can we expect for an interest rate on a DSCR loan? Are we 7% or above, 6%, 6-7%? What should we expect?
I think assuming really strong credit, I think you'd be just over 7.
Okay.
Maybe like 7.25. That's a guess, right? You can have to plug it all in and tell you where it would cash. A lot of it is based on does it even cash flow first and foremost? But you mentioned 1.1. I think you'd probably be just over 7. Yeah. Okay. Let's talk about how DSCR is calculated. So there's 2 kinds of DSCR. There's idiot DSCR, which is just rent divided by the monthly payment. It's very simple. What's the payment every month? What's the rent? Is the rent more than the payment, or is it at least the same? Okay, we're good. The other kind of DSCR is as you start to kind of scale. I don't know if we really have anybody in the group that's at this level, but as you start to really build a portfolio and you've got 10, 20, 30 houses, you might want to start to consider this net operating income and what that means. And this is really how multifamily properties are underwritten. So we're looking at gross rent, and when we say gross rent, what we're referring to is annualized. And then you would assign a vacancy factor. So very common would be 5%, but this will vary depending on the submarket. Taxes, insurance, property management, repairs and maintenance, maybe general administrative. If you have a big enough building, maybe there's payroll you're paying. Capital expenditures, that'd be like, hey, like, every few years I got to replace the roof or I have to do roof repairs. Right? Like those were things that would get factored into that CapEx figure. NCF DSCR says NOI, right, which is all of this, divided by your annualized principal and interest right now. So that's something that you might want to think about as you really start to scale your portfolio. You might want to start getting away from pity DSCR where we're just cash flowing at a 1.0 and now start to think about like, hey, I really need margin because I need more buffer here because this is really turning into more of a business than it is this side thing that I'm doing to save for retirement.
So to read between the lines, I think it's the idea is that, hey, when we're first starting off, we're trying to get into these deals and make them work, but that may be a less sophisticated approach because yes, you may get qualified on the DSCR, but you may actually have negative cash flow on that project because you're not considering all of the other factors that go into it, like vacancy, property management, capex, etc. So you're
Yes,
saying as you get more sophisticated, you'll want to take into account the other factors because you'll want a real picture of how well operated the business is.
exactly.
Yeah.
Exactly right. All right, so now I'm going to dive into like a real, oops, what is this? Give me 1 second to find my deal analyzer, and then I'm going to do a BRRRR in real time and show you guys how I would analyze this. Am I still sharing? Can't hear you.
Yep, you are. I can see it. If you can just expand it, like zoom in a little bit.
Is it, like zoom in this way?
Yeah, exactly. Perfect.
Yeah, okay.
Okay,
So
perfect.
let's go back to our example I used earlier, which is 400,000, 50K in rehab. Oops.
Can I ask real quick, when you're considering the 50K, is this total rehab cost for this project?
Uh-huh.
Labor and materials, that's everything.
Correct. Yeah. Total rehab needed. Yep. So I'm going to try and simplify this as much as possible. Essentially, cells that are in blue are ones that you would want to edit. So assuming a down payment of 15%, it does the math for you and it tells you it's 390. And then there are rate and point assumptions already built into the tool. I mean, you can change these, maybe it's, 11 and 1.5. And this does the math for you. When we were talking about our initial loan to cost or total loan to cost, it's all right here for you. So this is kind of the start to getting it set up. And then as you start to work through this, you can edit other fields and it will start to kind of tell you some things based on what you've provided. So I've set this up so you can get it really nitty gritty and tell you exactly like what's the per diem interest. Per diem interest is the amount of interest that you'd pay from the date of closing through your first payment. Which, again, depending on how detailed you want to be, you can do that. You can also
Just to point out to the group, so that per diem interest is actually calculated for your whole project, right? So if you see where he has it there, 103.89, that's the interest that you pay every day. So if it takes you, let's say, 4 months to get through a project, it's 120 days at 103.89. So when you're thinking about your interest costs, a lot of us think of it as monthly payment, but you really want to think of it as a per diem.
true, but also you want to keep in mind that this per diem analysis is calculated for closing purposes, and the per diem is only charged on your initial advance, which is this cell right here. As this grows, that number is going to change, and it might only change by a few dollars, but I'm just trying to be as accurate as I can in presenting
You're saying
this.
that as you take draws on the project, right? I take a
The payment
$20,000
increases.
draw, then I have additional, let's say, 11% charge to that, and then a per diem calculation on that 20,000
Exactly right.
Right.
Exactly right. So typically things that you'll pay at closing, and this is, I for this section right here, when I say this section, I'm referring to these 3 cells. I would really encourage you to speak with both an insurance agent and the title agent. Title agent to do a better job of estimating, but typically what we see is it's about 1.25% of the loan amount, and then you'll typically have to get the taxes current, and then you got to pay insurance, right? And these are, fairly common estimates, for this. The next thing is, we outline what our reserve requirement is. So a common thing, and I could talk for another 30 minutes about reserves, but a common thing that you'll see lenders in our space requires, they'll just say, hey, 6 months and 10%. So what that means is they want to see that you've got 6 months of the minimum payment, right? Recall there's an undrawn balance and a drawn balance where the payment is smaller and the payment gets larger. They'll just say, well, we just need you to have 6 months of the minimum payment and 10% of the budget, which candidly, in my opinion, is way too low. So Renovo, we try to simplify things. We say, hey, 12.5% of your loan balance post-close. That means that you need to have the money to close, which we're estimating is this figure right here. But after you have that, you really should have this number too. So that's a general rule of thumb with us is that, and then that number varies depending on how many active projects you have with us. So then I start to kind of dive deeper into like, how much is the holding cost going to cost me? So you'll notice that 0% of the budget is our minimum payment. You'll notice that matches this number here, 3117. And then as you draw from the budget, you say, hey, I take my first month, I'm taking a 20% draw. And then after that, 40, and then 80, and then it's 100. And then, oh man, it's actually going to sit for a little longer. So I'm going to do another, right? And I just update these cells. Now, if you want to go super conservative, which I would encourage you to, you can underwrite based on a fully drawn balance the whole time, which is already over on the right-hand side. Any questions on this so far? Yeah. And then I take you down to a profit. The reason why this is all blank, by the way, is because you can expand this out to 2 years, which is far too much, but you get the idea. So then it sums up the carry cost, right, which we have here. And then it takes out the closing costs from the cells above. What does it cost you to borrow money? We talk about how lenders make money. This is it right here. And then we dive into a profitability analysis. So if we're selling it for $585, we got to pay back our lender. We've got an agent commission. Oh, okay, we negotiated lower. Okay, it's 4%. You can update the cell. It'll fix it for you. You got to pay title costs again. Everyone's getting paid in these real estate transactions. I'm sure you guys have figured this out already. And then, when you think about profit, you want to think about, well, I've already spent money into the deal, right? I've paid holding costs, which I've covered right here. And then I invested my down payment, my closing costs, which is right here. So how much of that is actual profit? Well, the answer is $55,000. Now, what does that mean? How much did I have into the deal, and what's my return on that? So I've invested $104,000, a 53% return on my money. Right, this is commonly referred to as like cash on cash. Sometimes cash on cash doesn't factor in holding costs, whereas this does. And then said differently, like what is the profit, right? So what is my percentage of profit on my sale price, right? Like profit margin. Mark talks about this a lot when he brings his sheets. So that's that. David asked earlier, and I hid these cells, but I can unhide them.
Comments in the group that this spreadsheet is amazing and that we want it to be posted on the school platform.
I will save this and send it over shortly. This is the way that we analyze it internally, right? Because I was telling you that like this is not something that gets shared, but this is the math that they do. Say, what's the ARV? Let's take a 10% haircut. What does that come out to? And then this is the analysis. I actually need to double check this profit number seems low. So let me double check that calculation before I send it over. All right, so now we're saying, hey, Mark just got done telling me, I wish I kept more rentals over the years. I'm really kicking myself. So now I want to analyze every deal as if it were a buy and hold. Okay, great. So I have a tab here at the bottom. It says DSCR. So we've got this property. We're keeping it for $585. I'd really like to pull some money out. So I'm going to go up to 75%, which is the max that most lenders will allow for. So we've got a new loan now of 438,750. I got to pay off my old loan, and then there's some assumptions in here about what you would get in cash out, and then what you'd get in cash out after paying fees and escrows. Escrows are something that people don't think about enough when figuring out a when they're thinking about a DSCR loan. So I tried to cover that here. I think the rate might be a little bit better. Let's say it's 7.2. I don't know. It's not going to change that much. And then
can you zoom in for us when you went to the next sheet? It popped it back
Sorry.
up. Yep. No problem.
And then we want to talk about rents, right? So there's what you're getting for rent and what the monthly market rent is, and those are typically two different things. Ideally you're getting market rent, but if you're getting under market rent, or let's actually say that differently. Let's say you're getting over market rent. You'll notice that the sheet didn't update this effective annual rent because we're using the lower of the two numbers. And this is an important thing to consider. The property taxes, I actually reassess them on here. And what I have found, and Keely, I'd love to hear your thoughts on this, is a lot of times, and this is totally an oversimplification, but most frequently it's 2% of the original purchase price. Would you agree with that or no?
For assessing what the property taxes are going to be when they're reassessed.
Mm-hmm. You buy this deal at 400. What did I say?
I'd say
400.
Yeah, that's probably pretty accurate. I think that it's yeah, I would say that's probably pretty accurate because there wouldn't be any homestead or there'd
it might be 1.9. It might be
no deductions. I think that's a good ballpark.
Conservative,
I think a
right?
good thing for people to do would be, always to kind of check the property appraiser's website in Tampa has a link where you can double check. They give you a range, right? But like for Mark and I, when we've looked at deals that we've considered keeping, we want to kind of fact check also that part that the lender is analyzing, because if they're off, and let's say that affects our cash flow by $200 or $300 a month, right? That could be a problem. So I would go and look at like the range on the property appraiser's website. And just for the purposes, not necessarily that you want to disclose that to the lender and mess up, kind of the loan and what they're doing. But I think understanding like, hey, there's a possibility that it could be higher than 2%, for example, on this specific property. And kind of using that high end of the range to crunch your numbers and make sure it still works just in case.
Exactly.
But yeah, I think that's definitely a good, just kind of general rule of thumb to do back of the napkin math on.
Yeah. So you're free to go to the property appraiser or this setup to just do 2% of whatever you paid for the property. 2,500 is a general rule of thumb. I mean, if you're in a flood zone, double, maybe triple. It could vary. If there's an HOA, that's something that you want to factor in because we as the lender would factor that in. Additional expenses, here's some examples of what that could be: repairs and maintenance, utilities, landscaping, reserves, property management, miscellaneous. I don't know, like what are some things that might come up? A rule that we use is it's about 13%. I forget which goes to what, but it's like 5% for a property manager, 3% for R&M, 2% for utilities. Like these things just kind of add up. So 13% is just kind of a number that we use, which is, I would argue, probably on the more conservative side. And then CapEx, this is like in the future, right? Like that roof isn't going to be good forever, and neither will the siding, and neither will, you're gonna have plumbing repairs. Like these are things to think about if you're running a real business. So you'll notice that on this deal, you're actually not really cash flow positive. So it doesn't work as a BRRRR, right? Now, maybe you say, hey, I don't actually need money out. I'm okay even bringing a little bit of money in because I'm serious about building wealth for my future. And maybe I don't need to take all that leverage up front. Maybe I'm going to put the money in that way I don't have to put it in later. Up to you. And now we're actually breaking even a little bit. And we've got some positive cash flow on the short-term end, right? Where we're talking about pity at DSCR, talking about just rent and payment here. Am I at least cash flow positive a little bit? Maybe I can build up some reserves. Maybe in 5-6 years, rates come down. I can get out of this 7 handle and I can get into 5% debt. Who knows? And I still don't pull money out, but I can at least start the loan over, lower my burden. Maybe rents have picked up by then. if you're sitting here watching this presentation, you're going, well, hey, man, I'm conservative and I see all these expenses and I recognize that running this would entail running a real business. And I know that repairs and maintenance are a real thing. And I know that utilities are a real thing. Why on earth would I want to do a deal where I'd be potentially losing money, $600 month over month? Well, the reason is you might need to buy some of these to offset some of your active income. If you have a day job that earns you a lot of money and you need something to kind of bring down your tax burden, this might be a good option for you. Again, speak with your CPA, speak with some other financial professionals, but there's a reason why people buy rentals that typically don't have amazing cash flow here, and that would be something to consider. So,
Hey,
I hope
John,
that's helpful.
question about these numbers. When you're running the ratio, and you said you took the lower of the two numbers,
Mhm.
is that for because you've got two numbers right there. You've got in place rent, and then you've got market
Monthly
rent,
market,
right?
yeah.
Yeah. So essentially, market is what it would appraise for based
Mhm.
off the comps, and then in place is you've got a lease in hand, and this is how much you're collecting currently in rent, right?
Yep. Yep.
Um, when uh, I'm assuming that you're taking the lower of the two to be conservative, or is that a
Mhm.
practice?
Yeah. Yeah. That's a common practice. That is not a Renovo thing. That's everybody does
Okay.
that. Yeah, you
So
can
is
actually
that,
see into all my cells here. So you can see the formula here. It's the minimum of these two cells,
yeah.
and then we annualize it.
So when you actually underwrite the loan, if you have a higher, I guess, rent schedule with a lease in hand, you'll still take, and that's, let's say that's higher than the monthly market. Would you still take the monthly market to run the actual ratio to
Mhm.
underwrite the loan? Okay.
Mhm. Yep, whichever's lower. Correct. Now, most frequently, if you have a lease in place, the people are paying 2,800. Most frequently, appraisers are not going to go out of their way to be like, "This is rented over market." Like they know what's going on. So now, if it's way over, I mean, then yeah, you might run into some trouble. So
Well, I'm specifically thinking about a scenario where, it is, as you already know, and Mark knows, I'm interested in the Section 8 program. And generally speaking, they pay above market rent. So you're looking at 110, 120% of market. So let's say rent is, $100 a month. You can expect for every $100, you're going to pull in about 115, 120 bucks.
yeah.
So when you get that lease in hand with the housing assistance program, are you still going to go based off the market value, or would you adjust for essentially that agreement with the housing program?
So two things to unpack there. The first is the most common thing that I see, David, with the housing assistance program, I'll refer to as the HAP.
Yeah,
Most
yeah,
frequent thing that I'll see with them is people will go online and they'll look up what the payment standards are. And they'll go
sure.
33606 housing standard, 3 bedroom is this.
Yeah,
Therefore, that's the number I'm using to underwrite. In
yeah,
reality, that's the max you can get, but that doesn't mean that that's what you're going to get. And
100%. Yeah.
I'm no Section 8 expert. Like I'm not going to pretend to be, but this is something that I deal with on a fairly regular basis. If someone will say, "Oh, I can get this number, so that's the number I should use." Well, at the end of the day, it's going to go off a market. Now, another thing, just because it's not on MLS doesn't mean it doesn't exist. So sometimes what will happen is you'll get, let's say you came to me and you wanted to refi, and you have a Section 8 rental, and let's pretend it's in South St. Pete. We look on South St. Pete, and for some reason, maybe South St. Pete's a bad example because you'd probably be able to find a million of these.
I mean, that's
Um,
exactly where I have my Section 8. So yeah, we're good.
all right, bad example, but let's pretend you couldn't find the
Okay,
listings on MLS under leased rent, under leased
sure.
listings.
Yeah.
What you could do, and we've actually done this in the past, is you can reach out to other property managers, or sometimes your property manager manages other Section 8 rentals in that immediate submarket, and
Hmm.
we can get those leases. We can give them to the appraiser. We can be like, "Hey, this isn't on MLS, but would you be willing to consider it?" And most
Okay.
frequently, they will, because landlords are lazy and they don't always post these things on MLS. So you know you gotta get data where you can, and that's a way to do it.
Do you know if
So
you can get that information from the housing assistance program? Is that something that they're able to
uh,
hand out?
I don't know if they'll share it. I mean, you're welcome to ask them. I think it'd probably be easier to just get with a property manager who manages other Section
Sure.
8 rentals, and I actually know one in South St. Pete. So you can
Okay.
with me after this, and I can
Love
introduce
that.
you if you want to hire her for a property manager, and she might have leases in the event that this shit comes up.
Awesome.
Any questions on this or any of it? By the way, this is Excel, so it's not perfect. It's pretty close. Gets you pretty close. If you run into issues with any of the calculations or you screwed something up, you're welcome to just call me. I built it, so I know how it works and can help you analyze
Great.
it.
Awesome.
So, get back to my PowerPoint. You see the contact me page?
Yep.
Great. All right. So, anyways, I hope this was helpful. I'd love to open it up for questions. I know there's been some. It looks like there's some in the chat here. I don't know if John's speaking my love language, Excel and numbers. Thank you. Spreadsheet is amazing. Cool. Awesome. Are there any other questions that weren't in this chat besides people's love for Excel?
I got a couple quick follow-ups if you don't mind.
Shoot.
It should be pretty quick. We talked about going Dutch on the loans with the interest paid. When you're calculating your loans for X amount of dollars and then you have a holdback, the loan origination points that you might charge on that, do you do that on the whole amount or just the initial draw?
Whole amount.
And then would you recommend getting pre-approved, or just coming with a deal in hand and then just jumping off the gun once you found a deal?
I think pre-approval is helpful. And the reason
Okay.
for that is, or at least is what I tell people, is that, you might not be in a rush now, but you might be in a rush later.
Yeah, exactly. Yeah.
So when you are in a rush, let's be in a rush together. And we're not
Yeah.
dealing with this thing that we could have done that was when it wasn't time sensitive.
Mhm.
And then last question on that one, and I agree wholeheartedly. I like to be ready as much as
Yeah.
possible.
Yeah, totally.
Would you encourage or essentially run the deal? Like, let's say I've got a deal that I wanna put in an offer on. Should I bring that to you first before I even submit my offer, and certainly before I send an EMD?
You're welcome to. You don't have to. More experienced investors are probably not leaning on me as much for that, and maybe newer customers are going, "Hey, I'm looking at this. What do you think?"
Yeah.
And experienced investors are not infallible, by the way. I have a guy who's got, from a completed deals perspective, probably more than Mark and Keeley, and he sent me a deal in Palmetto last week, and I looked at it and I nicely told him that I wasn't a fan of it, and I said, I think the comps that you're picking are for larger houses. This one was like 600 square feet, and all the ones he was picking was 900 square feet. Now, on a 3,000 square foot house, 300 square feet isn't much, but from 600 to 900, that's a huge difference, right? You think about it as a percentage of GLA. So, I'm honest with people, and I say, listen, like, I'm not seeing this, and like your rehab budget is telling me that you're not adding square footage. So, like, what do you know about this that I don't? And
Awesome.
So you're welcome to run stuff by me. Yeah.
Awesome. I love that. Great. I think that's it for me.
Cool. Amazing. Anybody else have any other questions I can?
Royce, I saw that you jumped on. Did you have one?
Yeah. First off, thanks for your time, John.
Yeah, my pleasure.
Real quick, you mentioned scope of work earlier.
Yep.
So what are your expectations related to that as far as what the borrower produces upfront? And then kind of second part to that question is, while the project is underway, do you kind of reconcile like the performance against that project plan or that scope of work? How do you kind of use that later on potentially?
So the scope of work is something that gets completed as part of the needs list. So we'd send you a list and we'd say, hey, please provide a scope of work. Typically, you want to have more in there than not enough. Now, sometimes people have a misconception about like how much detail is required. Like, oh, I'm replacing all the doors, so each door is $300, $400, and I'm putting 10, so 400 times 10. It's like, man, you can just keep it more simple, like doors, $4,000. Move on.
Right.
We have a very pretty lengthy and detailed scope of work template that you're welcome to fill out, and the intent behind it is to spur thought in your mind and go, oh yeah, I didn't think about that. Like I probably should include a line item for X, Y, or Z. Yeah, as you get more experience, you realize that you're like, listen, I know what I'm doing. I need paint, floors, demo, landscape, boom, 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 right? Like that's the
So we're going to do like a follow-up. We wanted to have John do kind of hard money basics first, because obviously for those who are completely new, that's the first part of understanding how to actually get the loan. So kind of as a piggyback on this, we're going to do a kind of just focus on the draw schedule and submitting your rehab budget, a separate SME, I think probably next week. I got to get Mark to give me a date, where we're going to talk about what John just said, like, you can get super detailed. It's probably smarter to just put a bulk price for doors, right? And there's a reason behind that. It's because that makes it easier when you go to get your reimbursement. So there's, understanding kind of costs of things. There's what do we lump together? And then there's kind of like tricks that you learn as you become more seasoned on how to get your reimbursements just quicker and more efficiently. What kind of order does that look like? Again, kind of what's lumped together. So we'll do that like as a part two, kind of separate SME call within the next like week or so. Because I think that's hugely beneficial for people. You make a lot of mistakes typically when you submit your scope of work to the lender, as a new flipper, right? You'll overlook things. That's why John's saying this is more so to create a thought so that you don't forget some certain items. So like I know when Sterling did his flip, and he talked about this at the onsite that he hosted, he had completely forgot to include a line item for electrical, right? And so now there's no reimbursement for electrical. So that's cash out of his bank account that he's not going to get back until he actually sells the property. So like the checklist and the scope of work, it's great for that. But there's also kind of a whole separate thing to understanding how is this going to play out when I go to get my reimbursements, right? So
and
yeah.
some lenders, not every lender, let's say you did forget 10K for electrical. You can move money from one line item to another in some cases, and it's up to the lender's discretion, us included. But sometimes it's as simple as saying, like, hey, I decided not to paint the outside. I'm going to paint it at the end, and I'll cover that. But I'd really like this money for the electrical now. Like, you can do that in some cases.
Hey, John, do you require a holdback for the rehab, or do you guys do just straight up money for the purchase?
Great question. The terms are different, right? So
Mhm.
the type of lending that we're doing is speculative in nature. So the thought is if we don't know what the end goal is or why it'll be worth more, it's a much lower initial loan to cost.
Mhm.
If we know that there's value add contemplated and we know that there's a plan in place, then the advance rate is higher. And I always tell people um, it's the cheapest insurance policy you're going to buy. Because you asked me earlier, are the points charged on the initial advance or are they charged on the total loan? Well, they're charged on the total loan. So let's just do the math on that real quick. Let's pretend you get a $50,000 rehab, and we as the lender are charging you 1.5% on that. 750 bucks.
Yeah.
Really?
Insurance policy, right? Yeah. Yeah.
We can't squabble over 750 bucks for doing business together. Like it's silly. 750 bucks, and now you have access to 50K.
Yeah.
Like unless you were literally just like got money coming out of your ears, then maybe you don't even need to borrow. But it would be foolish not to borrow it.
Sure.
Let's have a few fire round questions for you, and then we'll let you wrap up because we're keeping you. We appreciate you giving us all the time.
Yeah, and I appreciate
So,
the
thinking about the
opportunity.
lens of our group, what are the most common mistakes? So, let me preface with John gets to see borrowers or operators of all types, right? From early stage operators to bona fide seven figure businesses, and some even multiple seven figures. So with that in mind, what are the common mistakes that you see made by investors as they're first starting off or they're scaling their business? What are some things to think about for us as a group?
Underestimating uh, renovation costs, underestimating how long it takes, overestimating ARV. Those are the big ones.
Yep. If we are in the stage where we're beginning to scale our business, and do multiple projects at a time, what advice would you give that investor?
So you start with one and see how well it goes.
Let's say we have
Unless,
our first few under our belt.
yeah. I mean, I'd love to see them close by one another. Love to see that you have a niche in a neighborhood. I like that.
Yep.
Part of our lending philosophy is that I'm here, you're here, we're all here. We're not like here and then we're also doing a deal in Atlanta. Like that's 8 hours away, man. What are you doing? That's
Sure,
the idea is like
sure.
let's focus where we can just physically drive out there and fix whatever needs to be fixed,
Sure.
and have eyes on the project and make sure the subs are working right. Like that's the idea. Is just keep it local, man. I love local.
I think the thought there is, if you have a more clear strategy, it's more likely for you to get support from your lender to scale your business, right? When they can say, hey, I think they have a clear idea of what they want to be, what they want to
Yeah,
do, right? The
yeah.
areas that they invest in. Okay.
And then to piggyback on that, just I don't really feel like I beat it up a lot on this call, but like reserves, right? So, let's say you had 3 projects with me, the requirement goes from 12.5% of the loan level balance to 10% of all of them. So if you get 3 deals that are each 400K loan amount, so that's 1.2 in debt, we'd want to see that you have 10% of that liquid, right?
Anybody else? Any questions? Last minute questions for John? All right. Well, John, thank you so much. This has been amazing. I think we went pretty far beyond the basics, which is really helpful to really give us an idea of what it takes to work with a lender partner. But we appreciate your knowledge and for you being so patient with us, staying long on the line.
Yeah,
So
my
thank
pleasure.
you, John
Thanks for
Robbart.
having
Thank
me.
you, John.
Thanks,
Thanks,
John. That was
everybody.
fantastic.
Talk soon,
Thank you.
everybody.
All right,
Bye.
guys.